Everyone would love to purchase a stock and have it provide exponential returns. We all know that one person who bought Apple stock when it first IPO'd, or someone who bought Coca-Cola stock before the price took off. Early investments in successful companies such as these would be enough to retire on in many cases. How do you even begin to select a solid investment on your own instead of listening to other stock tips? There are 4 main points to look for, and those are referred to by investors as the 4 M's. When a business meets all 4 of the criteria, the chances are much higher that your choice will be a profitable one. These are the 4 most important aspects of a business to consider before purchasing its stock. My name is Chris, and I help teach people about money, personal finance, and investing. If you're interested in improving your financial future, make sure to subscribe to the channel and hit the like button if this video is helpful. Meaning. You want to buy a business, not just a stock. It's important that a business has meaning to you. Sure, you could buy a stock just to make a quick buck, but you want to own a business that you know well enough to own all of it. You want to feel comfortable owning the company forever, even if your whole family depended on it. You want to be proud of what you own and see your money invested as a vote for that company and what they stand for. Being proud of that company, their motives, and what they're doing will make you an interested shareholder who cares enough about their financial health that ultimately affects your wallet. It's also likely that if the company has meaning to you, you use their products or services. Customers who use products and services of a company almost have insider knowledge. MOAT. A moat is obviously water around a castle to protect it, but in investing terms, a moat is a competitive advantage that a company has to protect it from others. When you buy a piece of a business, you want to know whether its future success is predictable instead of just assuming it will be. If it's been a good investment in the past, it's likely to continue to be profitable in the future, right? That might be the case, but it's not necessarily true. There are generally 5 different types of moats that add to the certainty of upcoming and continued success. Brand. If a company has a brand moat, this means customers are willing to pay more because they trust it. Examples of these brands are Disney, McDonald's, Pepsi, Nike, and Coke. You could walk into the store and have the choice of Coke or a less expensive generic brand, and most people are going to choose Coke, even if the recipe were exactly the same. They're familiar with the brand and are willing to pay more just for that reason. Coke never really has to worry about its customers choosing something else. These companies are also able to raise their prices with inflation because people don't always care what the price is. Secret. This is a business that has a patent or secret that makes competition very difficult or even illegal. A brand like Pfizer or 3M has a secret moat because they have patents or legal protection for them or secret ways to make their products. 3M has over 100,000 patents on products, so even if a competitor were able to duplicate a product, they couldn't legally do so. Those patents give 3M a huge competitive advantage. Intel also has a huge moat because they've been making chips for so long. The only way you'd get their knowledge is to hire their employees. Toll. A business with exclusive control over a market is able to collect a toll from anyone needing that product or service in the same way you pay a road toll to get to your destination. In order to get where or what you want, you must pay. A perfect example of this is PG&E. It's the only utility company that provides power to that region in California. To get power in that area, you either need to buy it from PG&E or create your own supply. Google has a toll moat because in order to advertise in their space, you need to pay their advertising fees, or toll. Switching. A business that's ingrained in your everyday life has this kind of moat. To switch from using their products or services, it would be a major inconvenience. Apple has this kind of moat. For example, an Apple consumer likely has an iPhone, a Mac, and maybe an iPad. They know exactly how these products and their operating systems work, and they all work well together. For this reason, their customers are extremely loyal. To switch to using a different company's products, it would not only be difficult to learn how to use them, it would be very expensive to change your phone, computer, and tablet. Price. The last type of moat is price. Some businesses are so large and established that it's hard for their smaller competitors to provide the same prices. Walmart, Costco, and Home Depot are all big players in their market, and for a smaller company to compete with them would be very difficult. When these big box stores are buying items in bulk, they get them cheaper and part of the savings is passed on to the consumer. Also, these stores know that customers will also be purchasing many more items while shopping. People like to complain how Home Depot is hurting their local hardware store, but they'll still shop there because the prices are better. Management. This is an important part of any business. Who's managing the business has the potential to make or break the company. Having a plan for future growth and taking responsibility for past failures are a couple of the characteristics you want to look for. Management who takes a reasonable salary and owns a large amount of company stock is someone safer to bet on than a CEO who takes an unbelievably sized salary and sells a large amount of their shares regularly. Founders usually make good management, people like Warren Buffett, Bill Gates, and Jeff Bezos. These CEOs basically have their entire life tied up into the business, and they won't want to see it fail. Margin of safety. Lastly, you must determine a great price at which you could purchase the stock. A margin of safety is the difference between the amount of expected profitability and its break-even point. Paying whatever price the stock is trading at is a terrible move. Sometimes the price could be a great one, allowing investors to purchase a great company at a fantastic price. Other times, the market is trading at exorbitant levels that make no sense in regards to its fundamentals. Determining which price makes a stock valued at full price and which price leaves a margin of safety requires some practice and knowledge of how to do fundamental analysis. Simply put, don't buy a stock that seems to be trading at full price. Try for 50% off to provide a sufficient buffer. A company could lose its CEO, a competitor could take market share even if it has an established moat, it could run into legal trouble, or its demand for the products or services could fail for another reason. Most of us remember Blockbuster, Toys R Us, Borders, and Sears. There were times when no one expected these companies to go under. There are many reasons why a business might run into trouble and perform worse than expected, which is why it's critical to buy at a discount. When you've properly screened a stock for the 4 M's, the chances are much higher that you're going to be buying the next Apple or Coca-Cola. Even if you're not that lucky, you can still make a nice profit using these principles. Buying companies that don't meet these criteria is basically like throwing darts, and that's not a way to be successful in the stock market. Instead of blindly purchasing a stock that's been recommended to you, take a hard look at the company itself to see if it's a sensible place to put your money. Does the company have meaning, a moat, great management, and can you buy it at a discount? If the answer is no to any of those, don't buy. Trust the process and don't just purchase based on emotion. These 4 M's are widely known in the investing world and are used by many successful investors, so be sure to use them to your advantage. Without doing proper research, you'd be better off putting all that money into a broad market fund.